Gold just had its best single day in months. Over 3% in one session, and the reason it happened is sitting on a foundation that could crack at any moment. That's the story today, and it's worth understanding every layer of it before you draw any conclusions about where this market is heading. Welcome to the Gold Report. I'm AI Ryan Matta. Real Ryan put this together this morning, wrote every word of it, then handed it off to me before the rest of his day swallowed him whole. That's the arrangement. He does the research and the thinking, and I deliver it to you so it actually gets out the door. Today, we're breaking down the biggest gold move in weeks, what caused it, why the analysts are already pumping the brakes on the celebration, and what the bigger picture looks like for anyone holding gold or thinking about it right now. Let's get into it. Here's what happened in the last 24 hours. The United States and Iran agreed to a 2-week ceasefire. That's the headline, and gold responded immediately. Spot gold surged more than 3% on May 6th, crossing $4,700 per ounce. COMEX futures came in close behind, approaching $4,718. As of this morning, May 7th, gold is sitting at $4,153 per ounce. That is the highest price gold has seen in over a week, and it came fast. 3 things moved at the same time to produce that jump. The US dollar weakened, oil prices dropped, and treasury yields softened. When all 3 of those happen together, gold gets a strong tailwind from every direction simultaneously. That's exactly what played out on Wednesday. Now let's talk about the context, because without it, this number doesn't mean much. Gold hit an all-time high of nearly $5,600 per ounce in late January 2026. Then a war started. The US and Iran went into direct conflict at the end of February, and gold, which you'd expect to shoot higher during a war, actually got crushed. The metal dropped over 10% in a single session at one point. It went on to post its worst monthly performance since 2008. Since the war began on February 28th, gold is down 9% from those highs. The reason for that is something a lot of people don't fully understand about gold, and it's worth spending a minute on. Gold is a traditional inflation hedge. The logic is simple. When the purchasing power of the dollar goes down, gold holds its value. So in theory, war, which drives up oil prices, which drives up inflation, should be great for gold. But there's a catch. When inflation gets bad enough that central banks start raising interest rates or keeping them high to fight it, gold loses its shine. Because gold pays you nothing. No dividend, no yield, no interest. When you can put money in a treasury bond and earn 4% or 5% instead, there's a real cost to sitting in gold. Institutional money starts rotating out. That's exactly what happened over the past few months. Brent crude spiked as high as 126 at a barrel. Inflation fears spiked with it. The Federal Reserve, already reluctant to cut rates, became even more locked in. Money markets right now are pricing in 0 Fed rate cuts for the rest of 2026. Not one. And in that environment, the same war that should have been bullish for gold became a headwind because of what it did to the rate picture. The ceasefire changes that calculation. Or at least it starts to. Axios reported that the White House is nearing a framework agreement with Iran, a 1-page memorandum of understanding that would require Iran to accept enhanced UN inspections, halt nuclear enrichment for 12 to 15 years, and potentially transfer highly enriched uranium out of the country. In return, the US would gradually lift sanctions and unfreeze billions in Iranian assets. Trump said significant progress had been achieved and announced a temporary pause in the US-led maritime protection mission in the Strait of Hormuz while negotiations continue. The Strait of Hormuz matters enormously here. It's one of the world's most critical shipping choke points for oil. It had effectively been closed since the war began. If it reopens, oil supply that's been bottled up starts flowing again. Oil prices fall, inflation pressure eases, and suddenly the Fed has room to consider cutting rates again. That chain of events is what lit gold up on Wednesday. One analyst at Active Trades put it plainly. A peace deal that normalizes shipping through the strait would alleviate inflationary pressures and create the conditions for the Fed to cut rates in 2026. And in a scenario where the Persian Gulf stabilizes, gold could revisit levels above $5,000 and approach $5,500 by year end. That's the bull case if the ceasefire holds. Morgan Stanley, for their part, has gold at $5,200 for the second half of 2026. That's actually a downward revision from their previous target of $5,700. They cut the target because of the rate environment and the sustained selling pressure from the war. Goldman Sachs is sitting at $5,400. Wells Fargo is the most aggressive of the major banks, with an upside target of $6,300 per ounce. WisdomTree's commodities research head has $5,500 as his conservative lower boundary by Q1 2027, and even his bear case floor is modeled at $4,630. The range of serious institutional forecasts is all pointing in the same direction. The debate is over how high and how fast, not over whether the structural trend is intact. But here's where you need to slow down. The same analysts who are pointing toward $5,000 and $5,500 are also being very careful about the word fragile. Edward Muir at MEXC said it directly. There are so many elements that still need to be negotiated, they could easily unravel. This is a 2-week ceasefire, not a signed peace treaty. The Strait of Hormuz blockade on ships traveling to and from Iranian ports is still in place. Trump paused one part of the military operation, not all of it. Ahmed Asiri at Pepperstone framed it well. Gold pushing above $4,800 on the ceasefire news represents a recalibration of risk, not a full regime shift. What that means in plain terms is this. The market is now pricing in a lower probability of the war dragging on, but it's not fully pricing in peace. There's still a discount built into gold relative to where it was before all of this started. That gap only closes if the deal actually gets done and holds together. So the honest position right now is that gold got a significant one-day bounce on credible peace signals. The direction of that move is correct if the ceasefire leads somewhere real. But anyone treating Wednesday's 3% jump as the all clear is getting ahead of the evidence. Let's look at what the market was doing underneath the surface during the sell-off, because this part of the story matters a lot for understanding where conviction actually sits. During the worst of the selling, Turkey's central bank sold 52 tons of gold between late February and late March. ETFs flipped from buying 150 tons in January and February to selling 90 tons in March as expectations for Fed rate cuts evaporated. Systematic trading strategies, the algorithmic funds that follow momentum, started selling aggressively when gold broke its 50-day and then its 100-day moving averages back to back. Daily outflows hit a peak of 14 tons on March 19th. And then something important happened. Gold stopped falling at its 200-day moving average. The 200-day moving average is a technical level that long-term investors and institutional money managers watch closely. It represents roughly a year of average price action. When an asset holds that level during a major sell-off, it signals that the big patient money didn't panic out. Morgan Stanley specifically called this out as evidence that long-term conviction held through the worst of the selling pressure. The people who believe in gold's structural role as a monetary asset stayed in their positions. The selling came from shorter-term holders and algorithmic funds reacting to momentum. The foundation didn't move. Gold is still up 8.5% year to date, even after all of that. Even after the worst monthly performance since 2008, even after an all-time high turned into a 9% drawdown from the peak, the metal is still positive on the year because January's run to nearly $5,600 was that strong. Now let's talk about where this fits into the bigger picture, because today's news is one data point inside a much larger story that has been building for several years. Central banks around the world have been buying gold at a pace that hasn't been seen in decades. JP Morgan projects around 705 tons of central bank gold purchases in 2026. That's below the 1,000 plus ton peaks of the last few years, but it's still roughly double what central banks were buying before 2022. The baseline of institutional buying has permanently shifted upward. These aren't short-term trades. Central banks buy gold as a reserve asset. They hold it for years. When they buy, that gold is effectively taken out of the tradable supply for a very long time. The bigger driver underneath all of this is de-dollarization. Not a dramatic collapse of the dollar, but a slow structural shift by countries that want to reduce their dependence on dollar-denominated reserves. When Russia's dollar reserves got frozen after the Ukraine conflict, every central bank in the world that wasn't fully aligned with Washington took note. Gold became the obvious alternative. It's nobody's liability. It can't be frozen. It can't be sanctioned. It's held in your vault and it's yours. That dynamic didn't start with this war, and it won't end when this war ends. The 2025 gold market produced 53 all-time highs. 53. The metal climbed approximately 65% through the year, its strongest annual performance in over 4 decades. Multiple 13 to 15% corrections happened inside that trend, and each one of them felt terrifying while it was happening. Each one turned out to be a re-entry point, not a top. The current setup looks structurally similar. Gold is sitting roughly 15% below its January 2026 all-time high. A 2-week ceasefire just gave it a 3% day. If the ceasefire evolves into a real deal, oil comes down, inflation eases, and the Fed gets room to cut, this market has a clear path back toward $5,000 and higher. Wisdom Tree's modeled downside, even in the bear case, is 4,630. That's the floor if everything goes wrong. The upside from banks like Goldman and Wells Fargo runs to $5,400 and $6,300 respectively. The asymmetry is meaningful. You're sitting roughly 15% below an all-time high that was hit just 4 months ago, with institutional demand structurally elevated, central banks buying at historically high rates, and the primary headwind being a geopolitical conflict that just showed its first real signs of resolution. That's not a guarantee of anything. But as a risk-reward setup, it's worth understanding clearly. The one thing worth keeping in mind is that this ceasefire is 2 weeks old as of right now. Every element of the framework agreement still needs to be negotiated. The Strait of Hormuz is not yet open to normal shipping. Iran still has the ability to walk away. If the deal unravels, oil prices spike again, inflation fears come back, rate cut expectations evaporate again, and gold faces the same headwinds it's been dealing with since late February. That's the risk on the other side of this trade, and any honest read of this moment has to include it. What you have today is a market that caught a meaningful break after 3 months of selling pressure, moved sharply on legitimate news, and is now sitting at a level where the direction from here depends almost entirely on whether two governments can finish a negotiation that has decades of history working against it. The long-term holders who didn't sell at the 200-day moving average are in a better position today than they were 48 hours ago. The people who bought at $5,500 in January are still underwater, and the people watching from the sideline are trying to figure out whether this is the re-entry moment or a head fake. That's exactly the kind of tension that makes a market interesting to follow. If this kind of daily breakdown is useful to you, subscribe to the channel. We do this every day across gold, macro, and Bitcoin. Real numbers, real context. And head over to bitcoinmaxing.com. Ryan built a free Bitcoin retirement calculator there. You put in your current stack and your timeline, and it maps out what different price scenarios could mean for your financial future. It takes about 2 minutes, and it reframes how you think about your holdings completely. That's bitcoinmaxing.com. Free tool, go check it out.